The moment global crypto adoption took a significant turn didn't happen in a loud congressional setting, a grand tech event, or during a well-publicized Bitcoin conference. What if the barrier between traditional finance and your digital wallet was just unlocked quietly at night without anyone noticing? Check your social media feeds now. Look at the mainstream financial news. The constant chatter you see is just a distraction. Analysts and commentators are busy analyzing daily price charts, claiming that the markets are stuck due to regulatory uncertainty. They want you to think Wall Street is frozen in fear, waiting for a signal from politicians. However, the reality beneath the surface tells a different story. Wall Street's absence from crypto isn't solely due to regulations. The real issue is transparency. A major investment bank or hedge fund can't use a public ledger where everyone can see their trades, front-run their positions, and track their relationships in real time. Complete visibility is dangerous in high finance. Consequently, they didn't wait for public blockchains to evolve. They built their own private networks. This is the Canton Network, a private, secure blockchain where trades remain hidden from the public yet visible to regulators. Recently, the bridge between this private network and your wallet was completed. Circle launched a private digital dollar on it, while Kraken activated the user-friendly connection. As a result, the trillions of dollars waiting on the sidelines have a smooth path into the digital asset world. My name is Noel. Welcome back to the Signal and Noise podcast. Take a moment to hit the like and subscribe button to protect your capital from the mainstream media's oversights. Today we'll break down the quiet capture. We will reveal how the Canton Network works, cover the major financing tests by Citadel and TradeWeb, and show you how to adjust your portfolio before the flood of institutional money begins. Now, let's get started. To grasp why this development is crucial, we must look past the hype around Web3 and examine the real operational challenges facing institutional capital. For years, the crypto community believed that radical transparency was the blockchain's best feature. However, to a Wall Street trader or large investment fund, complete transparency is a major problem. If an institution tries to move a $5 billion position on a public ledger like Ethereum or Bitcoin, that wallet address gets flagged by bots. Competitors see the transaction, figure out the strategy, and trade ahead, causing huge losses. Under strict banking regulations, institutions can't risk working with unverified partners. If a bank accidentally deals with a wallet linked to illegal activities, they face serious consequences. This is the Canton Network, a private, secure blockchain where trades remain hidden from the public, yet visible to regulators. Created by Digital Asset and supported by major financial institutions, Canton addresses the privacy issue. It operates as a permissioned network. When two institutions conduct a transaction on Canton, only they can access the transaction details. The compliance angle is crucial. While the public can't see the data, the system has built-in regulatory nodes. If an auditor needs to check for compliance, the platform can provide secure access without exposing the trade. Wall Street didn't want to disrupt blockchain's efficiency, they aimed to refine it. With Canton, they created a parallel universe that retains the speed and quick settlement of decentralized ledgers while ensuring total corporate privacy. Now, let's discuss a significant development that has taken place. A private network remains isolated until someone connects it to the wider system. In recent months, 3 key events created a direct link to retail liquidity. The launch of USDCX Circle, the issuer of one of the most compliant stablecoins, introduced a new asset called USDCX on the Canton Network. This isn't just another stablecoin. It's a private digital dollar designed to facilitate trillions in institutional transactions, fully backed by actual cash and short-term U.S. treasuries. The Kraken activation. As institutions traded USDCX, Kraken enabled user access to this infrastructure. This means regular retail capital can be converted into institutional-grade liquidity easily. The Federal Reserve Master Account. This is the key element of the entire scenario. Kraken activated this feature using a secure Federal Reserve Master Account. Consider the significance of this infrastructure. A Federal Reserve Master Account allows institutions to bypass commercial banks and settle transactions directly with the central bank. By linking a Fed-connected exchange to a private blockchain with a compliant digital dollar, Wall Street has effectively blended the traditional financial system with the crypto economy into one network. If you believe this is a distant concept that won't affect the markets for years, you're misreading the situation. Real capital tests have already taken place successfully. A group of major market makers and financial tech firms, including Citadel Securities, DRW, Goldman Sachs, and Tradeweb, carried out a large pilot program on the Canton Network. They didn't just trade fake tokens, they executed real treasury transactions, collateral swaps, and margin management processes. They demonstrated that tokenized real-world assets could be moved, settled, and used as collateral across different financial systems in seconds, not days. In traditional finance, moving collateral for a trade can take up to 48 hours due to manual processes. On the Canton Network, Citadel can improve its capital efficiency instantly. This is where retail investors may be left in the dark. While the average trader waits for an ETF announcement or a celebrity endorsement, the infrastructure supporting global financial markets is being moved onto private ledgers. The technology is ready, the biggest liquidity providers have validated it, and the system is prepared to scale. Now let's summarize the key points regarding Wall Street's private crypto rail. The noise. Major banks dislike crypto, regulations aim to stifle the asset class, and institutional money will remain away due to fear. The signal. Institutions have quietly adjusted blockchain to meet their needs. By addressing the privacy issue with Canton and linking it to retail access via Fed entities, they have created a hidden, frictionless route for global capital. So what's the strategy for managing this quiet change? First, ignore the loud headlines. Real macro changes happen in the technical details, the API integrations, the clearing links, and the stablecoin standards. When the infrastructure is set to manage trillions, liquidity will come. Second, know where that capital will go. Institutional investors do not focus on speculative coins or unverified protocols. When trillions flow through compliant networks, they will likely head straight into major assets with deep liquidity, established custody, and regulatory frameworks. Position yourself before this wave starts. Understand the infrastructure, or you risk losing opportunities. Stay alert, stay informed. This isn't financial advice. Please do your own research. That's it for this infrastructure-focused edition of the Signal and Noise podcast. Don't forget to hit the like and subscribe button before you go. Follow the quiet developments, protect your portfolio from distractions, and we'll catch you on the next episode.